Welcome back to the Deep Dive. You know we love diving deep into investment strategies, and today, we're switching gears a bit. We're going beyond, those classic Buffett picks like Coca-Cola and Gillette
Right.
to uncover a side of Warren Buffett that you might not, be as familiar with.
Yeah. Not as talked about.
Yeah, exactly. And that's his fixed income strategy.
That's right. We're going to explore how the Oracle of Omaha, the guy known for those long-term stock investments, applies, while those same value investing principles to bonds, to the world of fixed income.
Yeah, and get ready for some surprises because we're diving deep into Chapter 9 of The Warren Buffett Way by Robert G. Hagstrom
Great book.
to discover how Buffett views, bonds as businesses. He hunts for those hidden bargains, and he's not afraid to, step into those areas that make other investors kind of nervous, like junk bonds.
Yeah. You might even say that fixed income securities play a bigger role in Buffett's portfolio than a lot of people realize.
Okay, so before we get into the specifics, can you give us a sense of just how important fixed income is to Buffett's overall investment approach?
It's definitely not an afterthought. Back in 1992, fixed income represented about 20% of Berkshire Hathaway's portfolio.
Hmm.
And then fast forward to 2006, that number had climbed to around 30%.
Whoa! Okay, so that's a significant chunk of his portfolio.
Yeah.
What's the reason behind that kind of allocation? Is it just because Berkshire Hathaway owns insurance companies, which typically have to hold a lot of bonds?
Well, that's part of it. Insurance companies, they need a certain percentage of their assets in fixed income just to meet their obligations to policyholders.
Right, of course.
But here's where it gets interesting. Berkshire actually holds a much smaller percentage of fixed income securities compared to other insurance giants.
Okay, so it sounds like Buffett's making a conscious choice to hold more fixed income than he's required to. So what's driving that decision?
Well, Buffett's guiding principle is seeking the highest after-tax returns,
Hmm.
regardless of the asset class. He's not ideologically bound to stocks or bonds. He goes where he sees the best opportunities.
I see. So he's not just, filling a quota. He's actively, looking for value in the fixed income world.
Exactly.
You mentioned earlier that Buffett sees bonds as businesses. Can you elaborate on what that means?
Absolutely. Instead of simply chasing interest rates or, following market trends like a lot of bond investors do, Buffett applies the same rigorous criteria he uses for his stock investments.
Okay.
He digs deep into a company's financials, looking for a margin of safety, commitment to their business, and of course that potential for profit. Most importantly, he wants to see strong, ethical leadership at the helm.
So he's looking for those undervalued bonds,
Right.
like those diamonds in the rough that the market is kind of mispriced, right?
Yeah.
It's not just about collecting interest payments. It's about understanding the underlying business and its potential.
Precisely. He's looking for companies with a solid foundation that are temporarily out of favor with the market, creating an opportunity to buy at a discount. And to really illustrate that, let's dive into one of the case studies from the book, The Washington Public Power Supply System Bonds, back in 1983.
Oh, this is the whoops bond story, right?
Yeah.
I remember reading about this. WPPSS defaulted on billions of dollars in bonds for nuclear reactors. And it sent like shockwaves through the bond market.
Yeah, it was a messy situation, with WPPSS defaulting on $2.25 billion in bonds for two unfinished nuclear power plants.
Yeah.
Everyone was panicking, dumping utility bonds like they were hot potatoes.
So what did Buffett do in the midst of all this chaos? Did he steer clear or did he see like an opportunity amidst the wreckage?
Buffett, as always, was thinking differently. He saw a crucial distinction between the defaulted projects,
Okay.
which were reactors 4 and 5, and 3 other WPPSS projects, projects 1, 2, and 3,
Gotcha.
that were fully operational and, importantly, backed by a government agency.
Interesting. So he wasn't just buying any WPPSS bond. He was really carefully analyzing the situation, looking for value where others just saw risk.
Exactly. It's a perfect example of his principle of differentiating between market panic and actual business value.
Hmm.
While everyone else was running for the hills, Buffett saw an opportunity to buy fundamentally sound assets at a fraction of their true worth.
Hmm.
He swooped in and purchased $139 million worth of these bonds, which were trading at a significant discount.
So what was his logic behind this? I mean, it still seems like a risky move, even if those specific projects were operational.
Well, he viewed the bonds for projects 1, 2, and 3 as a business, earning $22.7 million annually after tax.
Okay.
Those coupon payments, they represented his steady profit, and he was essentially buying that income stream at a fire sale price. He saw it as getting a healthy operating business for 50 cents on the dollar.
That's a compelling way to look at it. So
Yeah.
did this, contrarian bet pay off for him?
It absolutely did. The bonds eventually doubled in price, providing Berkshire with a 15 to 17% tax-free return.
Wow. So even in the midst of a bond market meltdown,
Right.
Buffett found a way to profit by staying calm, thinking rationally, and focusing on intrinsic value rather than kind of market sentiment.
Precisely. It highlights a key element of his investment philosophy, the ability to remain objective and see value where others only see fear. And this wasn't a fluke either.
Right.
Let's fast forward to the late 1980s and early 1990s, the era of junk bonds.
The greed is good decade, right?
Yeah.
Filled with those leveraged buyouts and high yield debt.
Right.
I'm guessing Buffett, known for his kind of conservative approach, wasn't exactly a fan of the junk bond craze.
You're right. He was notoriously skeptical of junk bonds, famously comparing them to drinking the Kool-Aid at Jonestown. He saw them as inherently risky, often issued by companies with shaky financials and, well, questionable management.
Right.
Yeah.
But then, in 1989, the junk bond market crashed spectacularly.
Yeah, it did.
Did this change his mind about junk bonds? Did
No.
he suddenly see them as a buying opportunity?
Not quite. He didn't suddenly become a junk bond enthusiast. He still recognized the inherent risks.
Oh.
However, he also saw that the market panic was creating some interesting opportunities.
Yeah.
Some solid companies with strong underlying businesses were being unfairly punished alongside the truly risky ones.
So he was looking for those babies that got thrown out with the bathwater.
Exactly.
Interesting. Are there any specific examples that come to mind?
Well, one notable example is RJR Nabisco,
Okay.
which had been taken private in a massive leveraged buyout financed with, you guessed it, junk bonds.
Yeah.
The company was saddled with a mountain of debt, and when the junk bond market crashed, RJR Nabisco's bonds plummeted in value.
That sounds like a recipe for disaster.
Yeah.
What did Buffett see in RJR Nabisco that others missed? Did he think they could actually handle all that debt?
He did. He believed that the company's core business, its iconic brands like Oreo cookies and Winston cigarettes, was strong enough to weather the storm. He saw that the market was overreacting, creating an opportunity to buy those bonds at a steep discount.
So he was essentially betting on a turnaround story.
In a sense, yes. He was betting that RJR Nabisco would be able to manage its debt, generate enough cash flow to service those bonds, and eventually restore its financial health. He saw it as a business with a very attractive 14.4% yield.
That's a hefty return.
Hmm.
So how did this contrarian play turn out? Did he manage to find another diamond in the rough?
He did indeed. RJR Nabisco ultimately retired its junk bonds at face value a couple of years later, giving Berkshire a cool $150 million profit.
Wow.
It was another example of Buffett's ability to see value where others only saw risk, to remain calm when everyone else is panicking, and to capitalize on market dislocations.
Okay, I'm starting to see a pattern here. Buffett isn't afraid to go against the grain, even when it comes to something as seemingly risky as junk bonds.
Yeah.
He's always looking for those mispriced opportunities, those situations where the market's fear creates a bargain for him.
Exactly. He's not afraid to zig when everyone else sags. And that independent thinking, combined with his deep understanding of value investing, has consistently led him to those kind of outsized returns.
Yeah.
But what's even more interesting is that he's willing to apply this approach to areas that you wouldn't typically associate with him, like the tech sector.
Now, that's a curveball I didn't see coming. Buffett investing in tech. That's definitely not something you hear every day.
Right. But it just goes to show that he's not dogmatic. He's willing to adapt and explore new areas when the value proposition is compelling enough. And that's what we'll explore in the next part of our deep dive. We'll take a look at Buffett's foray into the tech world, specifically his investment in Level 3 communications.
I'm intrigued. I can't wait to hear how that one played out. So for our listeners who are starting to process all this information about Buffett's fixed income strategy, what's one key takeaway you'd want them to keep in mind as we move into the next part of our conversation?
Well, it's crucial to remember that Buffett doesn't approach fixed income as a completely separate discipline from his stock investments. He's looking for value and opportunity across all asset classes. He adapts his approach based on the situation, but those core principles of value investing remain constant.
That's a great point. It's about being a value investor first and foremost, not just a stock picker or a bond specialist. And with that, we'll wrap up this part of our deep dive. Join us in part 2 as we uncover how Buffett blended his shrewd investment approach with personal relationships in a deal that brought two Omaha legends together.
It's fascinating how Buffett can, spot value even in those turbulent markets, isn't it?
It is, yeah. It really makes you wonder what was going through his mind as he was, sifting through those distressed companies and junk bonds.
Right.
Was it like pure calculation, or was there like an element of gut feeling as well?
Hmm. That's a million-dollar question, right? I mean,
Yeah.
there's definitely a calculated aspect to it. He's meticulously analyzing the financials, assessing the risk, and looking for that margin of safety.
Right.
But there's also like an element of intuition and ability to see potential where others see only problems.
Speaking of seeing potential, let's shift gears now and explore how Buffett sometimes blends personal relationships with his shrewd investment approach.
Okay.
We touched on this briefly in the last part with level 3 communications, but the case study that really exemplifies this is Mid-American Energy Holdings Company.
Ah, yes, the deal that brought two Omaha Titans together, Buffett and his longtime friend, Walter Scott Jr.
Right. I'm curious to unpack this one a bit further. It
Yeah.
sounds like there's a lot more to this story than just a simple investment.
There is. It's a story about trust, opportunity, and a shared vision for the future energy. In March of 2000, Berkshire Hathaway acquired 34.56 million shares of Mid-American's convertible preferred stock, along with a smaller chunk of common stock for a total of $1.24 billion. And they didn't stop there. 2 years later, they added another $402 million worth of preferreds.
So this wasn't just a casual investment.
Yeah.
It was a significant commitment, both financially and strategically.
Right.
Absolutely. And it was a deal deeply rooted in personal connections. Walter Scott Jr., aside from being a close friend of Buffett's, was the chairman emeritus of Peter Kiewit Sons, a construction giant based in Omaha, and importantly, the chairman of Mid-American.
I see. So there's that element of personal trust that we've seen before in Buffett's deals.
Right.
He often talks about how he prefers to invest in businesses run by people he knows and admires.
Exactly. He values integrity and competence, and he finds those qualities reassuring, especially when he's making a major investment.
Right.
But the Mid-American deal wasn't just about friendship. It was also about opportunity, a shared vision for the future of the energy sector.
What kind of opportunity did they see?
Well, Buffett saw Mid-American as a platform for growth in that, rapidly evolving energy landscape.
Okay.
He committed to supporting their pipeline acquisitions, and get this, he was willing to provide up to $15 billion in financing.
$15 billion.
Yeah, it was like he was giving them a blank check to build an energy empire.
Wow, that's a serious vote of confidence. What did
Yeah.
they do with all that financial firepower?
Well, they went on a strategic shopping spree, acquiring a portfolio of key energy assets.
Okay.
Their first major purchase was the Kern River Gas Transmission Project,
Okay.
a 935-mile pipeline that transported natural gas. Buffett shelled out $960 million for that one.
Wow, that's a hefty price tag.
Yeah.
Any other notable acquisitions?
Oh, there's more. They then snapped up Dinnigy's Northern Natural Gas Pipeline for another $900 million.
Okay.
And they didn't stop there.
Oh, wow.
To really solidify their position in the natural gas market, they took a 30% stake in a massive new Alaskan natural gas pipeline project, with Berkshire contributing a cool $2 billion to the venture.
Wow. They were building a natural gas behemoth?
Yeah.
I'm sensing a theme here. It seems like Buffett was placing a big bet on the future of natural gas.
You're spot on. He saw natural gas as a key component of that, evolving energy mix, and he was using Mid-American as his vehicle to capitalize on that trend. He was positioning Berkshire to benefit from the growing demand for cleaner burning fuels.
That's some serious foresight.
Yeah.
But I'm curious, was this purely a financial play for him, or was there something more personal at work here, given his close relationship with Walter Scott Jr.?
It was a combination of both, I'd say. There was definitely the financial motivation, the potential for profit.
Right.
But there was also an element of partnership, of building something meaningful together.
Okay.
He trusted Walter Scott Jr. and David Sokol, Mid-American CEO, to execute their vision.
It sounds like a true collaboration, a meeting of the minds between a shrewd investor and experienced energy executives.
Yep.
Did Buffett take an active role in shaping Mid-American's strategy?
Well, he gave them a lot of autonomy, but he was certainly a key advisor and supporter. He offered his insights and guidance, leveraging his vast experience in capital allocation and deal-making.
So it was a balanced partnership,
Right.
a blend of trust, vision, and expertise.
Precisely. And the results speak for themselves. By 2003, Mid-American had become a major force in the energy industry, with $19 billion in assets and annual revenue of $6 billion. Berkshire was reaping the rewards, receiving about $300 million per year in dividends from its preferred stock, not to mention the significant appreciation of its common stock holdings.
Wow, that's a remarkable turnaround. So in a way, Buffett's fixed income investment in Mid-American wasn't just about generating income. It was about strategically positioning Berkshire for long-term growth in a sector he believed in.
Exactly. It shows how he thinks beyond just the numbers,
Right.
the interest rates, and the yields. He's looking at the bigger picture, the long-term trends, and the people behind the businesses.
Okay, we've covered a lot of ground here.
We
From distressed utility bonds to junk bonds and now this fascinating Mid-American saga. As we move on to explore other aspects of Buffett's fixed income approach, is there any specific takeaway you'd want our listener to keep in mind?
I think what strikes me is that Buffett doesn't view fixed income as a separate silo from his stock investments. He's always looking for the best opportunities to deploy capital, regardless of asset class.
Right.
He's adaptable and opportunistic, constantly seeking value wherever he can find it.
That's a great point. It's not about being a bond expert or a stock market guru.
Right.
It's about being a value investor, first and foremost.
Precisely.
Yeah.
And I think that's a key takeaway for anyone who wants to apply Buffett's principles to their own investing. It's about understanding the fundamentals, value, risk, and potential for profit.
Now, speaking of different approaches to investing,
Yeah.
you mentioned earlier that Buffett has been known to dabble in arbitrage.
Yeah.
What's his take on that strategy? I have to admit, it's a bit of a mystery to me.
Yeah, it can be a bit complex, but it essentially boils down to exploiting price differences for the same asset in different markets. Imagine finding a rare baseball card at a flea market for $5, knowing it sells for $50 online. That's arbitrage, buying low and selling high, to profit from that price discrepancy.
Okay, I get the concept. But how does Buffett apply this to the world of finance? Surely he's not scouring flea markets for undervalued baseball cards.
No, he's dealing with stocks and bonds, of course.
Yeah.
And the price discrepancies are often much smaller, requiring sophisticated analysis and quick execution.
Okay.
He's particularly interested in risk arbitrage,
Okay.
which involves buying securities of companies involved in mergers, acquisitions, or other special situations.
Yeah.
The idea is to buy the securities of a company that's being acquired at a price lower than the acquisition price, locking in a profit when the deal closes.
Interesting. So he's looking for those situations where a corporate action, like a merger or an acquisition, creates a predictable price movement,
Right.
allowing him to capitalize on the difference.
Precisely. It's all about finding those opportunities where the outcome is relatively certain, minimizing the risk.
Sounds like a clever way to generate consistent returns.
Yeah.
But I'm curious, if this strategy is so effective, why isn't everyone doing it?
Well, in practice, it's not as simple as it sounds.
Right.
The price differences are often tiny, requiring large sums of capital to generate meaningful profits.
Yeah.
Plus, there are transaction costs and the ever-present risk that the deal might fall apart before it closes, wiping out your potential gains.
Right. So it's a high-stakes
Oh my
game for
gosh.
those with deep pockets and nerves of steel.
Exactly. And even Buffett, with all his resources and expertise, has pulled back from arbitrage in recent years.
Really? Why the shift? Did he lose his touch?
Not at all. He simply recognized that the market had changed and those arbitrage opportunities were becoming less frequent and less profitable. The competition had intensified, making it harder to find those lucrative price discrepancies.
So the market has gotten more efficient,
Right.
and those kind of easy wins are harder to come by.
Precisely. Plus, Berkshire's portfolio has grown so massive that it needs to find bigger opportunities to really move the needle.
Right.
And those opportunities in recent years have been in areas like convertible preferred stocks, which we touched on earlier, and which we'll delve into further in the next part of our deep dive.
I'm intrigued. It sounds like these convertible preferreds offer a unique blend of fixed income and potential equity participation.
Yeah.
Something that seems to align perfectly with Buffett's investment philosophy. But before we get into that, what's one key takeaway you'd want our listener to keep in mind as we transition to this next topic.
Well, what's fascinating is that even though Buffett has used, a variety of fixed income strategies over the years,
Yeah.
he's not wedded to any particular approach. He's adaptable,
Right.
always willing to adjust his strategy as the market dictates.
Yeah, that adaptability is key, isn't it? It's not about being married to a specific strategy. It's about recognizing when the market's shifting and adjusting your approach accordingly.
Precisely. He's not afraid to, change course when the winds change. And that flexibility has certainly contributed to his long-term success. And speaking of adapting to new opportunities, let's dive into one of Buffett's favorite fixed income instruments, convertible preferred stocks.
Right. We've touched on these hybrids a few times already with
Yeah.
the level 3 and mid-American investments.
Right.
They seem to hold a special place in his portfolio.
They do. And for good reason. Convertible preferreds offer that unique blend of fixed income and potential equity participation that Buffett finds so appealing.
Yeah.
You see, they provide a regular dividend like a bond, which gives him that steady stream of income he loves. But they also have the option to be converted into common stock if the company's share price, takes off.
So it's like having the best of both worlds, the stability of a bond with the potential upside of a stock.
Exactly. He gets paid to wait and see how the company performs.
Right.
And what's interesting is that he primarily views these instruments as fixed income investments. He's not chasing the potential stock gains. He's focused on securing that reliable cash flow from the dividends.
That makes sense.
Yeah.
It aligns perfectly with his emphasis on minimizing risk and maximizing value.
Right.
It's about, getting a good return on your investment, even if the stock never reaches its full potential.
Precisely. The potential stock conversion is a bonus, the icing on the cake, but it's not the main course. He's structuring the deal to be profitable even if that conversion never happens.
It's that classic Buffett approach, heads I win, tails I don't lose too much.
Right.
I'm curious, are there any other notable examples of Buffett using this convertible preferred strategy?
Oh, there are several. He's used it to invest in a wide range of companies, from well-established blue chips like Gillette and American Express to more distressed situations like Salomon Brothers and US Air.
So he's not limiting this approach to a particular industry or market condition. It's a tool he's comfortable using across his portfolio.
Right. And the common thread, as always, is value.
Yeah.
He's looking for situations where the market is mispricing the convertible preferred,
Okay.
creating an opportunity for him to acquire it at a discount and lock in a favorable yield.
I see. So it's about finding those hidden gems, those undervalued assets that other investors are overlooking.
Exactly. It's that classic Buffett magic,
Yeah.
unearthing value, where others see only risk or complexity.
Okay. So we've covered a lot of ground today.
We have.
From those distressed utility bonds back in the 80s to junk bonds, arbitrage, and now these intriguing convertible preferreds. If you had to kind of sum up Buffett's fixed income strategy in like one core principle, what would it be?
I think it all comes back to his unwavering focus on value. Whether he's buying stocks, bonds, or entire companies, he's always searching for assets that are worth more than their current market price.
Yeah.
He's a master of finding those hidden gems, those diamonds in the rough that everyone else seems to miss.
It's that ability to see beyond the noise, to block out the market's fear and greed and focus on the fundamentals.
And that's a powerful lesson for all of us, whether we're managing millions or just starting to build our investment portfolios. Don't get swept up in the hype or the fear. Focus on the underlying value and be patient.
Absolutely. And never underestimate the power of thinking differently, of challenging conventional wisdom and looking for opportunities where others see only obstacles.
Buffett's success is a testament to the fact that it's possible to outperform the market by simply being, more rational, more disciplined, and more patient than the average investor.
Well said. So as we wrap up this deep dive into Warren Buffett's fixed income strategy, what's one final thought you'd leave our listener with? Something to, ponder as they continue their exploration of this fascinating world.
Well, here's something to consider. While we've explored some insightful examples from, the Warren Buffett way, it's important to remember that the investment world is constantly evolving.
Right.
What worked for Buffett in the past may not always be applicable in the future. The key takeaway is to learn from his principles, his mindset, his approach to analyzing value and risk. That's the real treasure he offers.
That's a great point. It's not about blindly copying his moves. It's about understanding his thinking, his process, and adapting it to our own, unique circumstances.
Exactly. We should strive to be students of the game, not just followers of the leader.
That's a fantastic note to end on. We hope you've enjoyed this deep dive into the often overlooked world of Warren Buffett's fixed income strategy. Until next time, keep learning, keep questioning, and keep seeking out those hidden gems of value.